Good morning, and thank you for joining us today for our Farm Foundation Forum 2022 Economic Outlook for Agriculture. We're so glad to have the opportunity to engage with you today and are thankful to Farm Credit for their support for this forum. My name is Sherry Rogie-Fiddler, and I'm the President and CEO of Farm Foundation, located just outside of Chicago, Illinois. I'm looking forward to today's discussion with our excellent panel we've assembled, who will provide us with valuable context and insights to keep top of mind as we look ahead into 2022. Before we get into today's program, I'd like to take just a few moments to share a bit more about Farm Foundation. We are a 501c3 nonprofit working at the intersection of agriculture and society to address challenges that affect the entire food and ag value chain. Specifically, we are an accelerator of practical solutions for agriculture, accelerating people and ideas into action. The three levers we use to accomplish this are policy, innovation, and education. Forums such as today's are just one part of our extensive program of work, which is guided by our vision to build trust and understanding at the intersection of agriculture and society, and our vision to build a future for farmers, our communities, and our world. We rely on partnerships to fund our work and increase our impact. So if you're interested in learning more about funding or partnering with us, I invite you to reach out to explore collaboration. At Farm Foundation, we challenge ourselves to find new ways to share the story of programs and events we offer while growing involvement in our efforts. This fall, we launched the Friends of Farm Foundation. With your enrollment as a friend, you will not only be helping to support the mission and vision of Farm Foundation, but you will also gain exclusive benefits such as first reads on issue papers, curated content, networking opportunities, and much more. Becoming a friend of Farm Foundation is an investment in building a better future for farmers, our communities, and our world. To learn more about being a friend of Farm Foundation, just check the link that is provided in the chat function of this webinar. I also encourage you to learn more about Farm Foundation and our work by visiting our website at farmfoundation.org or connecting with us on our social media platforms. If you're posting on social media about this morning's session, we ask that you please use hashtag FarmFoundationForum. As we get underway with today's forum, I would like to quickly just go over a few housekeeping notes. We invite you to submit questions by clicking the Q&A button at the bottom of your screen. Please do not use the chat to submit your questions. When submitting questions, please include your name and organization. And due to time limits, we may not be able to ask all questions submitted, but we'll certainly do our best. This forum is being recorded and will be posted on our website at farmfoundation.org, as well as our YouTube channel. We'll send out that link following today's program. And finally, when the forum concludes, you will receive a link to a short survey. Farm Foundation appreciates your feedback and your time in completing the survey. Now let's turn to today's forum topic. We have an outstanding panel of experts who will discuss what farmers, agribusiness leaders, and others in the food and ag sectors can expect to see with respect to ag markets, trade, equipment, and the economics of rising input costs in 2022. I'm particularly delighted to welcome our panel today because we get to highlight three of our Farm Foundation Roundtable Fellows, Ambassador Gregg Doud, our Board Chair Dan Basse, and Dr. Barr. Our new Farm Foundation AgResource Trade Fellow, Dr. Amanda Countryman, as well as an outstanding guest expert, Dr. Vroomen from the Fertilizer Institute. We'll introduce each of our panelists as they present, but now I'd like to get started by introducing our moderator for today. Ambassador Gregg Doud will be taking on the role of moderator for us today. Gregg is Vice President of Global Situational Awareness and Chief Economist with Aimpoint Research. Gregg works closely with members of the Executive Intelligence Network and plays a major role in the development of its thought leadership priorities. Prior to joining Aimpoint Research, Gregg served in the Office of the U.S. Trade Representative as Chief Agricultural Negotiator with the rank of U.S. Ambassador. He was one of the primary architects of the US-China Phase 1 trade agreement. Gregg has previously served as the president of the Commodity Markets Council and was a senior staff member of the Senate Agricultural Committee, helping to craft the 2012 Senate Farm Bill. So Gregg, I'll let you tell more as you wish, and I'll hand it over to you.
Well, good morning, and thank you, Sherry, and it's a pleasure to be with all of you. Excited to talk with everyone this morning and go through your questions about the 2022 outlook. And I think the timing of this is really interesting from my perspective as I have focused on agricultural trade a lot in my career. You know, U.S. agricultural exports last year, depending on how you crunch the numbers, were either 150 or 155 billion dollars, and that's an important piece of this. And I think the timing of this topic of agricultural trade is particularly important because we just saw the October trade data. And for the month of October 2021, it was historic. We had an all-time record high for U.S. soybean exports to China in dollar terms. And of course, higher commodity value prices helped that out. It was an all-time record for any month in history for U.S. agricultural exports to China overall. And it was an all-time record for total U.S. agricultural exports to the world. Just this last month of trade data that we see, October 2021. So the question is today, and as we do the outlook for 2022, can we improve upon this? What's the future of all this? What's it look like? And we have a great lineup today. And I'm going to introduce our first speaker this morning to talk about the outlook, Dr. Amanda Countryman. She is an associate professor in the Department of Ag and Resource Economics at Colorado State University. Her research examines the economic implications of international trade, focusing on the impacts of trade reform in agriculture. She teaches undergraduate, graduate, and professional courses in international trade, agribusiness, and agricultural economics at Colorado State. Prior to that, she was an ag economist at the USDA Economic Research Service here in Washington, D.C. And we're excited to have Dr. Countryman join us today because she was just very recently named the very first Farm Foundation Agricultural Economics Trade Fellow. So good morning, Amanda, and it's all ready for you to give us the outlook. Thank you.
Wonderful, thanks, Greg. And I also want to extend my heartfelt appreciation to the Farm Foundation for putting on this forum, and also to Farm Credit for supporting this really important platform and this forum today. So this morning, I am very pleased to give an agricultural trade and policy overview. In a brief amount of time, we're going to cover a relatively quick U.S. agricultural trade snapshot. We'll also talk a bit about US-China trade. As Greg mentioned, there's a lot of really exciting things happening when it comes to trade with China, and there is a lot to talk about. So I'll get us primed for what I suspect to be a good conversation after our presentations this morning. I'll also focus more on some trade policy highlights. So there's important trade happenings, not just with China, but some other key important trade partners as well that we'll focus on. There are also a lot of global challenges and uncertainty. We all know that these have been unprecedented times with lots of uncertainty throughout the global economy and markets. And so I'll highlight a few key things to be thinking about in terms of global challenges and uncertainty. So when we think about an outlook for US ag trade, as Greg mentioned, we had record exports at over $175 billion. When we think about the ag trade forecast for the fiscal year of 2022, and we also have imports at $165 billion. So there are a few things that are the key drivers for this increase in agricultural trade over the past 2 years. One of the big reasons for this boost is our increased trade with China, given the Phase 1 trade deal, the US-China Phase 1 trade deal, and we'll talk a bit more about that. And we've also had a depreciation of, or a weakened US dollar during the first big chunk of that time frame that is also a really important driver that we'll also talk about in a few minutes. So on the next slide, we can see some more detail when we think across the different product types. And there's going to be more discussion later from Dan about some commodity outlook. But some of the key drivers, as Gregg already mentioned, is that we've had increased exports of oil seeds and also across meat product categories. So on the next slide, you can see how we've had between 2020 through 2021, we had a weakened US dollar. And there were a lot of reasons for this. When we think about the tremendous fiscal stimulus that occurred, which went hand in hand with increased public debt and the budget deficit, as well as low interest rates and quantitative easing, those were key drivers of that weakened dollar that helped to boost trade in that 2020 to 2021 timeframe. We can see that we had an appreciation of the dollar starting in the summer this past year, and that was largely driven by challenges in Europe related to COVID-19, additional challenges related to government closures of industry and businesses. And so when Europe faced relatively large challenges starting in the summer, with additional challenges with COVID, the United States dollar, the US dollar, began to appreciate in the summer this past year. So on our next slide, let's talk about the US-China Phase 1 trade deal. So what's interesting is that when the deal went into place, the September 2020 tariffs were cut in half, but the previous tariff rounds remained. And so in a few minutes on the next slide, we'll see the continued tariff exposure that both US exports and US imports face between the US and China. But I just want to remind us that while we have this Phase 1 trade deal, there's still a lot that remains to be accomplished to improve US-China trade relations. When we think about the Phase 1 deal, there were commitments by China, and a lot of the focus has been on the purchases of US goods and services, which was for more than $200 billion over 2 years above 2017 levels. So we had purchase commitments by China to purchase US agriculture, manufacturing, energy, and services. There were some reductions in non-tariff measures that prohibited some trade related to food safety. There was some improved foreign investment measures, intellectual property protections were agreed upon, and there were some commitments related to currency by China. I think what is going to be really interesting to see moving forward is that when we think about a potential Phase 2 or a next round of a US-China trade deal, I believe that the focus is going to be a lot on the state-owned enterprises, which weren't really tackled under the Phase 1 deal. The graph that I have in this slide is from Chad Bown at the Peterson Institute for International Economics. And I think this is really interesting. It's a chart from early 2020, but what this shows us on the right-hand side of this graph, if we were to look at actual US exports to China, which is the solid blue line, if we think about export projections based on the trend projection, which is the dark blue dotted line, then if you were to anticipate accounting for Chinese GDP growth, what would US exports to China potentially be for agriculture? And then we have in red at the top are the export values required by the Phase 1 trade deal. So as Gregg already mentioned, the Phase 1 trade deal really set the stage for unprecedented exports to China across agricultural commodities. And so there was tremendous growth in US exports of agriculture beyond what would have been expected when we think about what export trends were to have said, and if we were to just account for growth in Chinese GDP. So I think that's also interesting context. When I previously mentioned that we still have substantial noteworthy tariffs in place on US exports to China, which is in the very top line, we can see in red, over 20% tariffs on US exports to China, and less than 20% in the blue line on Chinese exports or US imports from China. that's important context. When we look at the bottom of this chart, we can see in the red dashed line, when Chinese tariffs on exports on average from the rest of the world are a little over 6%, while US tariffs on rest of world exports are about 3%. So it's important again to remember we still face this tremendous tariff pressure between the US and China. On our next slide, this highlights this is a US-China Phase 1 purchase tracker. So this again is from the Peterson Institute of International Economics, and it shows us over time the commitments from China to purchase US goods and the actual purchases. So we can see in the top two dashed lines are the commitments, and in the red and blue solid lines underneath, the lower amounts are the actual purchases. So we can see that if we look at the percent of the target as of October 2021, it's 62% based on Chinese import data, or 60% based on US export data, has been the amount of total Chinese purchases from the US. On the next slide, we can see differentiation across sectors or industries. So on the left, we can see that agriculture has fared better relative to manufacturing and energy. Services are left off of this chart, but we can see that, again, agriculture, if we look at based on Chinese import data, is 76% of the target as of October this year. Manufacturing is 61% of the target, and energy is 48% of the target. And then in the bottom, this shows US exports by product type in billions of dollars based on US export data. On the next slide, I am simply highlighting agriculture. These are the same graphs from the previous slide, but just to highlight again the large amount of US exports of agricultural goods to China. So even though agriculture has come in at 76% of the target for 2021 compared to the commitments, 83% if you use US export data. These show the difference if you're using Chinese import data versus US export data. But even though for agriculture and across the board, purchases have come under commitments, it is very clear that these are still record exports to China that have been incredibly important for US agriculture. So on our next slide, I want to talk a bit more beyond China. So when it comes to US-China trade, I think it's going to be really interesting to see what is next. And I don't have a magic crystal ball, but I know that there is going to be a lot of interesting things continuing to happen with US-China trade relations. And I'm interested to see how the US and China will work together to tackle the extreme challenges related to state-owned enterprises, for example, and some of the other incredibly challenging production, trade, and policies that are within the Chinese economy that are challenging for our trade relations. I also want to mention the USMCA. So we have a new NAFTA agreement under USMCA that is, again, very important for agriculture. When we think about agriculture, a few things to highlight are there was some modest improvements for market access for US dairy and wheat into Canada. I think there's a lot of additional room for expansion in those spaces, but at least it's a small start relative to where we were under the original NAFTA agreement. There is a lot happening in the automobile manufacturing sector under USMCA. And there are some incredibly good things related to modernization with the new agreement. So there are intellectual property protections that are important for biotechnology and agriculture investment, and there are improvements related to labor and the environment. So moving beyond our North American trade agreement, another incredibly important recent agreement is the Japan-US mini trade agreement. So when the US withdrew from the Trans-Pacific Partnership, there was a lot of valid concern about lost market access for US agriculture into Japan. I think that was potentially one of the biggest wins of the Trans-Pacific Partnership. and those gains would be lost when the US withdrew from the Trans-Pacific Partnership. The US was able to reach a mini trade agreement that was largely focused on market access that did get the US much of the market access gains that were within the Trans-Pacific Partnership. There are still some additional market access barriers that remain that the US experiences and other CPTPP members do not. So I think that there is definitely room for improvement on this first step in having an agreement with the US and Japan. When we think about the CPTPP, the Comprehensive and Progressive Trans-Pacific Partnership, the 11 Pacific Rim countries continued without the United States. And while the US has agreements with many of the countries within the CPTPP, and now we have a mini trade agreement with Japan, it's important to note that we're not a part of that agreement, and the CPTPP continues to move forward. So for example, China is petitioning to join the CPTPP, and the US is not a member. Along with the CPTPP, we have the Regional Comprehensive Economic Partnership in Asia, which is 15 countries, including 10 ASEAN nations, South Korea, China, Japan, Australia, and New Zealand. So when we compare CPTPP with RCEP, while RCEP is a very large agreement, the market access gains are relatively minor, and the CPTPP is a much more comprehensive agreement that tackles much more than just market access. And so I think it's really important to keep an eye on what's happening with Asian trade moving forward, given that the United States is not a member of these really important agreements covering Asian trade. So as I've noted, the US lags on trade deals. So the EU, for example, is expanding trade and influence around the world and actively pursuing trade agreements. And as I also mentioned, China is petitioning for entry into the CPTPP. So again, the US is lagging as others have moved forward. This image simply shows how when we think about RCEP, CPTPP, and ASEAN, it shows the coverage and the overlapping across countries between these three agreements. And I'm highlighting that the US is not a part of these Asian trade deals. Again, just highlighting the importance of thinking about how the US can gain market access in the future moving forward. And I hope that there is potential for that moving forward. On the next slide, I think there's interesting potential for new agreements. So when we think about the transatlantic trade and investment partnership between the US and the EU, I'm very hopeful that one day there can be an agreement. This has been in talks for an incredibly long time, but there are a lot of challenges that remain for US-EU trade. So there's potential for increased market access, although tariff barriers or market access barriers between the EU and the US are relatively low. So there's a lot of additional improvements that can be made for US-EU trade, and a lot of those things are related to non-tariff measures and tariff rate quotas, for example. So there are opportunities to potentially harmonize regulations for trade, labor, and the environment, but there are tremendous challenges with non-tariff measures that restrict US exports, especially for agriculture, to the European Union. So I think one of the biggest challenges is that reduced restrictions on conventional US production practices seems unlikely, especially with continued advancements in the European Union that prohibit conventional production practices in US agriculture. When we think about livestock, meat, feed, and food crop production, there are tremendous constraints placed on US production practices that are allowable into the European Union. There are constraints on production practices across livestock and crop sectors. There's also potential for an agreement with the UK. Again, talks about a potential agreement with Kenya. And as I mentioned already, there are challenges about Southeast Asia. what are we going to do about Southeast Asia when Southeast Asian countries are continually moving forward and the US has been left out so far? And I won't say much about India other than it would be great to have a potential trade agreement with India, but they remain a challenge and they are facing some considerable challenges domestically, thinking about domestic policy related to agriculture specifically. So on this next slide, on our final slide, there are tremendous global challenges and uncertainty. There's uncertainty for US trade policy, which recently the focus has been on domestic policy and climate rather than really focusing on advancing trade policy. As I previously mentioned, the US lags others moving forward with trade agreements, and that is concerning when we think about trade and improving market access for US agriculture. The future of the WTO is uncertain. Again, there have been tremendous challenges with the WTO and the US relationship with the WTO. And so seeing improvement in that in the future and hopefully in the coming year, I think could be a positive thing moving forward. And then I have a handful of bullets that our subsequent speakers are going to talk much more about. So I'm giving a quick snapshot of some other really important things to be thinking about in the economy in the coming year. Supply chain challenges persist, and they are persistent across agriculture, across input markets, and we're going to hear more about that very soon. Unemployment remains puzzling and challenging. And so unemployment is a challenge. And the Federal Reserve recently has abandoned the idea that inflation is transitory. Inflation is not transitory, and that is now agreed upon across international institutions and the Fed. And we had 6.8% inflation in November, which was the highest in 39 years, which is incredibly concerning. The Fed is tapering and tightening monetary policy is on the horizon. Again, uncertainty related to COVID-19. And I do want to highlight among some very challenging prospects in the coming year, agriculture is faring well relative to others. As Gregg said, the past 2 years have been tremendous for US agriculture when we think about exports and global markets. I think there are tremendous opportunities for innovation as there's a continued focus on sustainability and regenerative agriculture. Agriculture is innovative, and I think that there's a lot of opportunity there. And there's potential for a lot of other shocks. We already know about anti-dumping and countervailing duties. These have been particularly important for the fertilizer market, which we'll hear more about in just a bit. Animal health shocks continue to be a challenge with African swine fever in China and also reaching the Caribbean. And we can also think about BSE in Brazil, which prohibited exports to China for 4 months and just reopened this week. So animal health is one of those hot topic things that can just pop up that persists. There are also potential shocks with energy and a lot of geopolitical concerns that I won't talk about now, but perhaps we can invite some questions about during our Q&A. So with that, thank you very much. And I'm going to pass this on back to Gregg.
Well, thank you, Dr. Countryman. Excellent presentation, and I think you've teed up a lot of questions or potential questions there, even on with regard to issues regarding food inflation and what the outlook for that is. It's a pretty interesting topic in and of itself right now. We're going to get going here with our next speaker, and it is an honor for me to introduce Dan Basse, president of AgResource Company in Chicago. Dan and I have been friends for 25 years. Dan has been a commodity analyst with Brock and Professional Farmers of America for 40 years. And for 30 of that, he's been one of the best in the business, unquestionably. And I am thrilled today, these days, that he's in the leadership of the Farm Foundation. He's with us here today. And Dan, really look forward to your comments today. Thank you.
Oh, Gregg, thank you for the kind and wonderful, nice introduction. I really appreciate it. And your friendship for 25 years means the world to me. Listen, if we could just click to the next, I want to thank Farm Foundation for all that they've done. This is a summit that I think is worthwhile. And I hope as we go through my slide set, I want to leave you maybe with 3 or 4 key points that I think as you look forward to 2022, that'll be important. So let's get to some of the highlights as I see right now. The market themes, number one, we think we're in a new commodity super cycle. We think the super cycle will last 2 to 3 years. Energy will be the upside leader. This transformation from fossil fuels to green fuels to ultimately electrical power or nuclear power is a bumpy road. And so the price of crude oil, the price of ethanol, the price of biodiesel, these are things that will really keep underpinning the agricultural markets. And ultimately, we believe there's going to be more farmland needed, mainly in Latin America and our friends in the Black Sea. I want to talk a little bit about peak U.S. farmland, a new concept that's been kicked around my office for the last couple of months. Next, Biden sees himself as a champion of biofuels. Obviously, he sees a low carbon footprint in our future, and biofuels are that stepping stone to electrification, having 20% of the U.S. auto fleet in place by 2030. So this push for biofuels is endemic. It's going to continue, and I'm going to talk a lot about renewable biodiesel as we get further along in the presentation. Next point. There's really 2 new ag drivers. If we look back in agriculture over the past 80 years, these demand drivers are so important to the profitability of our farmers. We think back to the Reconstruction effort after World War II, or the Russians coming with their gold bars in the 1970s to buy US grain. These were demand drivers that really lifted the fortunes and profitability of US farmers. Today, we have 2 of them that are brand new. We have China importing corn from the world, mainly the United States and Ukraine. That is due to African swine fever. And of course, they're banning now of feeding food waste, or how should I say it, throwing the scraps left from dinner out to the backyard hogs. That has been proliferating African swine fever and no longer can occur. With that in mind, the Chinese are now importing regularly 40 to 60 million metric tons of feed grains around the world. And then we have this renewable diesel product. This is a diesel, this is not biodiesel. This is a diesel product that is just like that in the pump that you would see today. It can be used in all seasons. It goes through a refining process. It adds an oxygenate, which through a cracker. So these are things that will dramatically alter landscape going forward. The U.S. beef and dairy herds are in liquidation. And so we think there's a very bright outlook for both of those sectors as we go through to 2022 and 2023. In the dairy industry, we see the opportunity as Europeans' dairy herd shrinks, and of course, the export opportunities increase for the United States. And lastly, U.S. farmland and farm incomes continue to rise, and we think this will happen into the next farm bill, which will be 2023 or 2024. Now, China is this demand pull. We just heard about China in the last presentation, but the Chinese are able to turn it off or turn it on through policy. Right now, they're trying to stamp out speculation. This has been ongoing and affecting the real estate market. China's food import policy aside, though, we see, of course, a dynamic and volatile market ahead for many agricultural sectors, with weather only amplifying the need for demand rationing. So for now, it's a shining of the raw material markets. Next. Just to set the table for everyone, when you look at global food prices, the UN provides a food price index each and every month. I highlighted here to the left, and notice since the pandemic has started, the sharp rise that we've seen in global food prices. And when we look at the chart to the right, this is the year-over-year change. And so for many of the impoverished world, this is a very, very problematic aspect. Next, if you would. What I've done here is I've highlighted where everyone sits at the global food table. So this is a chart showing you disposable income in terms of what each country is spending on food. We in the United States are very blessed to be at 6.7%. And when you think about the abundance that we all share at that low cost of disposable income, we are truly blessed. If we hit the, go one more on an animation here, you can see that these countries in this part of the world where they're spending 20 to 70% of their disposable income on food, that rise in world food prices is really catastrophic for them. And it's going to cause many political issues as we look forward. The Russians have recently put on a tax of grain exports so that they can tap down its own domestic grain price. These are things that political leadership will do around the world, but When someone in the United States comes to you and says, well, food prices are rising dramatically and it's a big problem, well, it may be a problem, but compared to the rest of the world, we as American farmers are producing the most abundant supply of food at the cheapest price it sits today. Next slide, if you will. Just to harken back on that inflationary story that we just heard from our last speaker, you can see here that as I look at the graphic, the CPI, the chart on the left, has been rising. We're now at the highest levels we can see going back for 39 years. I would tell the US Central Bank that one of the forecasters for that CPI is the CRB Commodity Index. This is a basket of 28 commodities weighted by demand. And as you look at that index, it has been a relatively good proxy for the CPI. So as commodity values go higher on demand, it will translate into higher inflation. I also wanted to mention, everybody knows the chart on the right, if I look at the price of equity markets relative to raw materials, notice where we are at the cycle. This is causing a lot of interest in the commodity sector. Chicago Board of Trade and the Commodity Futures Trading Commission provides data every Friday, which gives us the impact of speculator interest in the markets. Since September of last year, we've added about 1.2 million contracts to the agricultural side of things. So definitely interest in buying agricultural futures. Next slide, if you would. I'm going to talk a little bit now about what we believe is troubling. As you look at this graphic here, one of the things that we have been very blessed with is technology for agriculture that has kept per capita yields in the major crops of corn, soybeans, wheat, sorghum rising in almost every year. However, in the last 4 years, as we measure the metric tons per hectare, which is how we do it in world terms, you can see that we've stagnated on yields. Now, again, at our shop, we're wondering whether this is due to some changes in agronomic practices, but in a recent study, we found this is really due to what we consider to be climate change, more droughts, more floods, pattern stagnation. And so now, if technology is not raising yields at 1.6% that normally occurs because climate change is offsetting some of that, we're going to be needing more acres. Next slide, if you would. And so as you look at the per capita grain and oilseed stocks since 1970, as we've plateaued on global grain yields, we're now seeing that stocks of those grains are in decline. That line that you see there is a UN line that goes back to the 1970s, in which they called their food crisis line. Falling below there will get lots of attention within the media once again. We are not there today. But should we have a dire drought somewhere in a major producing country, we will slip below that line, and that will be somewhat concerning again for the world political leadership in the food table that we all sit upon. Next slide, if you would. Now, I want to maybe get along this concept of something that's crept up in our office called peak U.S. farmland. For the last 20 years, or I guess going back to this chart, we can look back to 2011, we have been stealing land from hay and CRP to get more principal crop acres. And we now believe that with the Vilsack, Secretary Vilsack wanting to have more land in the CRP Conservation Reserve Program, for those of you that don't know the acronym, that land, of course, will be increasing. He's looking at adding somewhere between 3 and 5 million acres, and they're now bidding upwards as close to $240 or $250 an acre to secure that fragile land in the CRP. But we also notice that hay acres are now sitting at their lowest level since 1909. And so when I combine both of these together, and you look at the chart to the right, which is the major crop seeded acreage, we believe we're bumping against levels in which we're maybe 20, 25 years ago, the EU was at a similar spot in time in which we peaked farmland in terms of utilization. A very interesting concept we'll think about going forward, but lots of ramifications for US agriculture. Next slide. Harry will be speaking to this a little while down in a few presentations, but I did want to point out the strong correlation between the price of fertilizer and the price of corn. What I've done here is plotted Central Illinois ammonia prices against CBOT corn and then NYMEX natural gas prices. And it's not a perfect fit. The R squared is about 0.72, But when traders and agricultural people and farmers talk about corn as fertilizer, there is a fair amount of truth to that statement. And obviously today, fertilizer prices, at least in terms of nitrogen, is sitting at record highs. Next slide. Next, if you would. Those two demand drivers that we'd like to talk about is number one, China and its corn due to African swine fever and their recovery. And then, of course, biofuels and this new hydrocracking renewable diesel product, which has been in the United States for many, many years, but now gaining a lot of traction because of social aspects of low carbon and an administration, at least not a federal mandate, but state mandates from California, Oregon, and Washington. Next slide. When you look at Chinese corn imports, you can really see the dramatic change that happened as China abandoned food waste, 30 to 34 million metric tons, and moved to importing more feed grains. In the right, you see a hog hotel, a major hotel in China housing 840,000 hogs. Nice mountain views for those hogs, but this is the new Chinese hog industry. It's biosecure. It's a westernized diet for these hogs. And so because of that, China is now importing 1 out of every 4 bushels of feed grains that are traded in the world. This is a big change in causing the corn market to maybe rear up and look at the opportunity that's ahead. In my career that now spans 42 years, this is the first time that I can tell my farm clients that I can look forward for the next 3 crop years and see corn above $5 a bushel. If I go all the way out to 2024, we're about $4.90 or near that. But this is the market reflecting this new demand driver of China's interest in world corn. Next slide, if you would. So one thing that we wonder is, of course, if corn is becoming the next soybeans. Back when China became a WTO member in 2001, China's soybean imports just skyrocketed, as you can see in blue to the chart to the right. Corn is now in that same position. But maybe more importantly, I wonder about the reserve stocks of China's grain. Now, USDA is reporting they have ample supplies, but notice that each year China auctions off to supply domestic needs reserve grain from its storeholds. So this year, they've only auctioned out somewhere around 29 million metric tons. But as you look backwards in time, notice that they've auctioned off as much as 96 million metric tons of corn in 2018. Now, if China doesn't auction off corn, wheat, or rice, they must turn to the world market. So this is something to carefully watch, especially with corn prices in China now at $10.65 a bushel. Next slide. A little bit about what I think is going to be the most disruptive fundamental in agriculture for the next 3 years. It is this renewable diesel. The chart from the left is, of course, existing and expected renewable diesel production going out to 2024. Now, this is when, of course, states like California, which are providing tremendous subsidies and mandating 700 million gallons of usage, you can see how quickly this is all ramping up. Now, if I take the existing under construction and proposed or announced plants, and we just had 2 new ones announced overnight, I come up with US soybean oil demand doubling over the next 3 years. Now, on these plants, I'm assuming a utilization rate of 80%. My oil industry friends tell me that I'm too low on that number. Nonetheless, a jump of a 2-fold jump in soy oil demand would be dramatic. 50 million pounds compared to where we are sitting today at 25 million pounds. What does this mean for US agriculture? Well, on the next slide, US crush capacity, because in each bushel of soybeans, it needs to go through a processor to get that 47.5 pounds of meal and 11.7 pounds of oil. When you look at the amount of crush capacity to get to the plants that have enough feedstock, this is what the soy crush would have to do. Maybe more importantly, if I need to crush 4.3 billion bushels of US soybeans, I need harvested acreage for that crop just to skyrocket. Now, again, this is all proposed based on those plants coming online, being efficient, being, moving into production, and then using probably 70% of their supply as soybean oil as a feedstock. In US harvested acreage of soybeans in the next 3 years, this would model out to an additional 40 million acres It seems impossible. And I believe it is impossible because there is no way, if we're at peak land, that all of those soybean acres could come online and displace corn or sorghum or cotton or other crops. And so I don't know how this is all going to play out, but this is a big fundamental that we all need to monitor over the next year or so. In the first quarter of 2022, I've got 1.2 billion pounds of additional renewable soybean demand coming online, diesel demand. Next slide. Now, importantly, today, we are looking at world global grain stock use ratios of the major exporters near or record lows. So there just is no cushion, if you will, if there's any kind of weather problems around the world. In the case of wheat, we are sitting at a record low in terms of stocks use of major exporters, only 19 days. So if I break out global wheat use and look at what exporters will have at the end of the crop year, there is only 19 days of stocks remaining. That is the lowest the world has ever seen. Corn is down to a similar or even lower level. Soybeans a little more ample because of our friends in Latin America. But this whole shortfall of global grain in terms of exporters' positions is going to be very important as we go into 2022. Next slide. One of the reasons I say that is because we have La Nina, which is that cooling of the equatorial Pacific that is now reaching near record levels. Now, La Nina is expected to peak during the month of January. What I've done for you is plotted La Nina and what it means for Argentinian corn yields. There tends to be this correlation between that cold equatorial Pacific water and lower yields in southern Brazil and Argentina. Already we're seeing drought starting to attach itself to southern Brazil, but from Paraná southward to Rio Grande, and we're now moving into a very dry period in Argentina. So the Argentinians, being the world's third largest corn exporter, can really not afford a yield drop of 10% or less. This is something to watch very closely as we go into the next year. Next slide. So if we at AgResource and my staff model out stock use ratios of the major exporters, which is a very good proxy for where prices will be moving, we can look at the market making a high without a significant South American weather problem between $6.40 and $7.20 a bushel. So near last year's $7.75 level, which peaked the market back in May. Again, feed grain prices will be staying very high. And if the corn market stays high, that means wheat and soybeans will follow suit. Next slide. In the case of soybeans, if we have normal South American weather, we are seeing an increase of G3 stocks. G3 stands for Argentina, Brazil, and of course, the United States. Those are the three principal producers of soybeans around the world. As of January 1st, I can measure their stocks, and you can see that we're up about 8%, 8.3% in terms of that stocks level. If I then model that out in terms of what it means for price, it projects a high of about $13.38 for January soybean futures. To date, we've made a high somewhere in the $13 range. But if this weather problem accentuates itself in Latin America, I do believe that $13.40 level will come into play and be tested. Next slide, please. So understanding that the US is at this peak farmland, understanding that grain stocks are in the United States, major grain stocks are looking at some of their lowest levels going back to the drought of 2012. It will take many years to replenish US grain stocks and many years to, of course, cause exporters' overall stock level to rise. This is why I believe that the volatility in the markets of grain will be acute, and we are looking at higher prices for maybe an extended period of time. Next, if you would. Now, speaking just a minute about the EU and the dairy industry as it comes to the United States, the US dairy industry has suffered going back to 2014 as the EU liberalized its trade policy and dumped a lot of powder and dairy products on the overall market. US dairy farmers, of course, during the pandemic, because of the lack of processing capacity, were forced to dump milk and seeing very low prices. However, we now believe that that pendulum is starting to change. EU dairy herd is now at 22.4 million at the end of this year, likely to decline further next year under a farm to fork proposal. And so as you look at world milk production, we think we're heading downwards with the US dairy industry well positioned to capitalize on smaller production in Oceania and of course the EU. Next slide. In the United States, dairy cow numbers are coming down. And in fact, for the first time, we believe that the US dairy industry will be producing below a year ago levels for 3 consecutive months, as you see to the chart to the right. So not only is the European dairy industry in liquidation, we are seeing the same thing here in the US dairy industry. It's been a long time since the US dairy herd has fallen below a prior year. Next slide. The other, of course, aspect that I think the US livestock industry will be very excited about is this bull market that's ongoing with, of course, the beef prices and cattle prices. As you look at the live cattle auction price here by region, you can see that we're now bumping against $1.42 a pound. However, as I look at the chart to the right, notice that how the choice cutout has really deviated from Kansas steers and the nearby CME price. Now we see the Biden administration pointing its finger at packers and saying, you know, you people are gouging the consumer. My response, or AgResource's response, would be that we need new packing facilities. We are at capacity. These packers are paying very high prices for labor, especially when they run a Saturday kill. And so this breakdown, if you will, in beef versus packer capacity really happened back in 2018. But there is a bull market in cattle that will persist, based on the next slide, if you would. As we are seeing cumulative beef cow slaughter rates now elevated to levels we have not seen going back to 2013 and 2012. So the drought in the Western US is forcing a lot of animals off pasture, off grass. Those animals are coming to market. And as we look at that elevated beef cow slaughter, we are going to see, or we're going to have a shortage of beef for many years to come. Also interesting to me is that a lot of the rally in beef prices is not related really so much to the packer as it is to what we call disposable income. When I look back and do per capita disposable income against the price of beef, notice how that skew on the left is very, very close. And so as the US consumer has higher wages and better jobs, we are seeing that disposable income, even with government aid transpiring into higher beef prices. Today, the beef price for retail beef is at a record $7.87 a pound. Next slide, if you would. So Gregg, I just want to turn it back to you. We've got some exciting times in dairy, beef, and grains. I think the volatility is going to remain even bigger next year. And so let's hope that Mother Nature really cooperates and provides good crops. But I'm already concerned about the dryness in your home state of Kansas. Back to you, sir.
Well, Dan, thank you. And for everybody listening, I just want you to know it doesn't get any better than that right there, folks. That is as good an outlook you're ever going to hear. But there's one topic, Dan, that we need to spend a little more time covering. That is a very interesting variable this year versus anything we've seen in any time in recent history, and that is the discussion about fertilizer prices. What a really remarkably interesting and hot topic fertilizer is right now. And our next speaker is Harry Vroomen, Vice President of Economic Services with the Fertilizer Institute. And so the best guy we could get to talk about fertilizer is with us today, and Harry, Harry manages all the Fertilizer Institute statistical programs, market analysis on the fertilizer industry, and he does the Fertilizer Institute's annual Outlook Conference. He's been there since 1994. Like one of our previous speakers, and Amanda, he too was an analyst before his time at Fertilizer with the Economic Research Service at USDA. Harry, tell us about fertilizer.
So again, the reason I'm here today, obviously, is to talk about fertilizer prices. You can see here the fertilizer prices are very high. And like many markets, obviously, fertilizer market is impacted by many different factors, and we're going to talk about a number of them today. But before I do that, I wanted to start with some background information to put the fertilizer market in perspective. As you might expect, China, India, the US, and Brazil are the largest consumers of fertilizer, commercial fertilizer. Overall, the US ranks third globally with all the nutrients combined, with just over 10% of the total. The important thing to point out here is while the US is a major player, again, you can see here that about 90% of global nutrient use is outside the US, which means that oftentimes that even if nothing changes in our market, demand from other countries can significantly impact the fertilizer market. Fertilizer demand globally is driven by corn, wheat, and rice. And if you add vegetables, fruits, and soybeans, you get to about 2/3 of global demand. For the US, it's driven obviously by the big row crops, corn, wheat, and soybeans. Corn alone accounts for about half of the fertilizer use in the US, and throw in wheat and soybeans, you're up to 70%. Now I'd like to turn to some simple analysis which shows that fertilizer prices have historically been closely tied to crop prices. And Dan touched on this earlier, but this chart shows 20 years of monthly prices received by US farmers for corn, soybeans, and wheat. And you can see in the little blue box there, the high correlation between these prices. And they're highly correlated for a number of reasons that I won't get into here as my time is limited. But as you can see, the corn price explains about 92.8% of the variation in the soybean price and vice versa. So they're very highly correlated. As the three crop prices are so highly correlated, I have combined them into one average price for these three crops. This graph shows the monthly average three crop price in blue and USDA's monthly fertilizer price index in green. Fertilizer prices, as Dan alluded to earlier, are highly correlated with the prices of these three crops, with a simple correlation coefficient of about 0.888. And again, in the blue box, you can see that fertilizer prices are correlated not just with corn, but with all the major row crops. So corn, wheat, and soybean plantings drive US fertilizer demand, and it's the influence of these crops and plantings that results in crop prices and fertilizer prices being highly correlated. That is, when crop prices rise, fertilizer prices also generally rise as fertilizer demand increases. However, despite the high correlation between crop and fertilizer prices, supply side factors are just as important. And ultimately, it is both demand and supply factors which determine the market price, not only of crops, but also of fertilizer. Thus, as can be seen in the chart, crop and fertilizer prices do not always track one another. You can see there in between 2003 and 2005, crop prices were significantly higher than fertilizer prices. In 08, 09, fertilizer prices significantly were higher than crop prices. And again, in about 2012 to 2014, due to drought and other conditions in the crop markets, the crop prices were higher. And of course, now what we're seeing is fertilizer prices higher than crop prices. Now I would like to turn to supply side factors, Nitrogen is produced in large chemical plants where you combine nitrogen and hydrogen. We'll talk a little more about that in a while. But one thing to keep in mind is when nitrogen prices go up, you can't just flip the switch and produce a lot more fertilizer. These plants are run at high operating rates because you can't produce just a little bit of ammonia. It's a chemical process that requires running at higher operating rates. Also, if you want to build a new plant, it takes about 3 to 5 years to build these new plants, billions of dollars of investment, and it doesn't happen overnight. Phosphate starts with the mining of phosphate rock, which is surface mining. You can see it starts here with these drag lines. When I first saw one of these drag lines, I was like a little kid in a candy store. These drag lines are 6 stories high. These buckets are amazingly huge, and this is a costly endeavor. It takes a lot of energy and years to start a phosphate rock mine. So again, you can't just change production overnight. Similarly with potash, potash is only produced in 14 countries worldwide. It's underground mining. These mines are anywhere from 1 kilometer to 1 mile underground. And basically everything that's done in these mines has to be brought up and down through an elevator shaft. So you've got to put these pieces of this machinery together. And so it all takes a long time to put this together. And again, these mines don't ramp up production very quickly overnight, and again, are also energy intensive. All these materials produced from these different processes then get sold as they are, or after processing, or combined with other nutrients to produce the fertilizer materials farmers use. Now, turning to this global producers, you can see here that the US is a large producer, the third largest producer of nitrogen and processed phosphates, but a relatively small producer of potash globally. We're the 12th largest producer of potash out of only 14 countries. We import most of our potash from Canada. And now I want to take some time and just to see the situation and outlook the global fertilizer industry was facing just 18 months ago, because I think it's really important to give that perspective. From mid-1920 to mid-2020, fertilizer prices were at their lowest levels in many years. We had and are still in a global pandemic. And the fertilizer outlook, you can see here this World Bank report from April 2020 was quite dismal. You can see here that the World Bank basically was saying that their fertilizer price index dropped 4.5% in the first quarter of 2020. That was the 7th consecutive quarterly decline. In 2020, the index was projected to fall another 10%. And then the upside risks included prolonged widespread supply disruptions, with downside risks as well on the demand side. So pretty bleak outlook. The International Fertilizer Association is a global association which develops global fertilizer demand forecasts through its correspondents around the world. And looking at the green line in this graph, before COVID started in December 2019, IFA was projecting about a 1% rise in fertilizer demand after the decline observed in 1819. By July 2020 and well into COVID, the red line on the graph, IFA revised its forecast downward significantly. So with crop markets still down, the outlook was pretty bleak, and this is what the industry was facing. But as we saw in Dan's presentation, and we'll see again in a minute, things changed significantly quite quickly. By November 2020, IFA's global fertilizer demand forecast increased significantly. The outlook changed because of the change in the crop markets. Using corn as an example, this graph shows season average prices for corn in green from 1718 through 1920. Beginning in May of each year, USDA reports a season average price forecast for the major crops, shown here in blue. As recently as August of 2020, just a little more than a year ago, USDA was forecasting a season average corn price of only $3.10, which would have been the lowest price in 14 years. These low crop prices, in this case for corn, after several down years, go a long way in explaining the pessimistic fertilizer demand forecasts noted earlier. But only 6 months later, in February of this year, USDA was projecting the highest season average corn price in 7 years. And as we saw earlier, all major fertilizer using crop prices have risen. Turning back to the supply side, producing fertilizer takes energy. Ammonia is produced by combining nitrogen from the atmosphere with hydrogen, typically from natural gas, at very high temperature and pressure. Energy plays a big role in producing fertilizer, transporting fertilizer, and applying fertilizer. And for ammonia production in particular, natural gas can account for 70 to 90% of the production cost, depending on the natural gas price. At $2.50 to $3.50 in MMBTU, natural gas accounts for about 70% of the ammonia production cost. When gas costs approach double digits, it's closer to 90% of the cost. Some of us remember what happened the last time natural gas prices rose in the US, the red line in this chart. Domestic ammonia plants closed as they could no longer compete with production from countries with lower natural gas prices. Domestic nitrogen production fell by 44%. But demand, of course, was still significant in the US for nitrogen. As a result, the green bars here, US nitrogen imports nearly doubled. So nitrogen imports, which typically accounted for about 25% of our total supply, went by 05-06 to nearly 60% of our total supply. But thanks to the shale revolution, natural gas prices have come down here, the red line, and you see that the US nitrogen industry has recovered, with some of the plants that had closed previously being revamped and reopened and new plants built. And we're now at about the same level of capacity as we were back in the year 2000. As a result, US imports of nitrogen have come back to earlier levels. However, the US still imports 6 million tons of nitrogen annually. And speaking of imports and trade, another important feature of fertilizer markets is that, like crop markets, the fertilizer market is truly global. You see here for the major crops, about 1 ton of every 5, or about 22%, get exported to a different country than where they're produced, which means a significant amount of trade. For fertilizer, that share is double, 44%, or close to half of all the fertilizer materials produced globally get exported to a different country. And again, this is a fertilizer trade map here. And again, you can just see from all the arrows that trade in fertilizer is very, very prominent, which means significant transportation costs by the time the fertilizer gets to the farmer. And these are features often forgotten when people look at the fertilizer market. As far as imports, again, the US is a large importer of fertilizer, particularly nitrogen and potash. And what that means is you have to pay the global price to import that material. And commodity prices, like fertilizer, tend to converge globally. And you can see that here. You can see that a major import market for urea, the US Gulf price, tracks quite closely with a major export market for urea. And again, global prices tend to converge for fertilizer as well as many commodities. You can see here that fertilizer prices in the US are higher for some materials than they are in other countries, but they're also lower, again, demonstrating that it's a global market. I'm not going to dwell on this, but again, the point here is that fertilizer prices are not just high in the US, they are high globally. Now, again, we talked about energy prices playing a big role, particularly for nitrogen. Well, you can see here that since the middle of last year, natural gas prices in the US have tripled. In Europe, which accounts for about 9% of global ammonia production, these prices are up 6-fold. As a result, over 40% of domestic nitrogen capacity in Europe and the EU is actually shut down because they can't operate at these high rates. Again, further tightening a global market. Costs of other inputs are up as well. You can see here that since the middle of last year, the costs of major inputs to producing DAP for a non-integrated producer have tripled. And then there are also many other supply side disruptions. One of the things is turnarounds. These nitrogen plants, again, as you saw, are big chemical plants, and they have 3 to 4 year maintenance schedules. They have to have turnarounds, pipes and other parts which can burst, need to be replaced. These turnarounds have to be done for safety reasons to prevent a loss of life, and high pressure explosives. And they have many consultants running around in their plants. You know, it could be up to 100 consultants running around to do these turnarounds. And of course, these were all delayed due to COVID, as you don't want all these contractors running around in your plants. So what's happened is this year, a lot of these turnarounds couldn't be delayed any longer. So not just in the US, but globally, we saw many more turnarounds which had to be done, which impacted production. Other supply side disruptions, as many of you recall, we had a big weather event, big freeze in February. About 60% of the ammonia production capacity in the US is in Oklahoma, Texas, and Louisiana. And as a result of those freezes, we had a big drop of nitrogen production in February as these plants were forced to close because they had no energy, they couldn't get natural gas, and just in preparation for the freeze. So we lost about 250,000 tons of nitrogen in February. That's about 300,000 tons of ammonia production lost. Despite that, production of nitrogen in the US was down only 2% in fiscal year 2021 compared to fiscal year 1920. And fiscal year 1920 was a record. It's the US hasn't produced that much nitrogen in many decades. Other disruptions, of course, Hurricane Ida also impacted production. We also had some trade disruptions. Some of you obviously heard about the phosphate countervailing duty. I'm not going to go into all the details, but obviously duties and countervailing duties and import taxes were put on phosphate and on phosphate for Russian and Moroccan producers, which did have an impact on the market. You can see here imports from Morocco and phosphate fell pretty dramatically right after the trade case was put in place. But you can see here that those imports have rebounded significantly, and they're up 43% through the third quarter of 2020. So again, that was a sort of a temporary impact here. There's also a trade case on nitrogen solutions currently going through the works at the International Trade Commission. Since that's a pending case, I'm not going to comment on that yet. We also had other sanctions here adding to the supply issues. You had global potash exports from Belarus have been sanctioned by the EU and the US. Again, they account for 21% of the global exports, so a significant supplier to the world market. And so this is a big dent in the supply. Similarly, China has put curbs on exports of phosphate and urea, as well as some other fertilizer materials. You see, this is important because China accounts for 25% of global phosphate exports. Well, if those are limited, that tightens the global supply. Same thing for urea. Russia, again, has also, as of December 1st, put quotas on their fertilizer exports. We're still waiting to see how this all plays out. But again, you can see Russia is a major, major fertilizer export. And again, this is just tightening a tight situation even further. And there are a number of other factors as well. I'm just going to touch on a few here. India subsidizes its fertilizer. And you can see here, they just approved an additional $3.8 billion in their subsidy. Again, what this does is it makes the fertilizer price to the Indian farmer below market prices, which artificially holds up demand in India. You also have additional supply disruption from Egypt, which has also tightened regulations imposed on fertilizer producers there. And they account also for 9% of urea global exports. So again, you see that that's how we got to this level of high fertilizer prices. And as we mentioned earlier, looking forward here, again, I'm not allowed to forecast fertilizer prices for antitrust reasons. And to be honest with you, in a market like this, if I really knew where fertilizer prices were going, I'd probably be on an island somewhere in the tropics drinking a drink on the beach. But I don't exactly. But I will tell you what's different from last time. You can see in 08, 09, really the prices there were driven by demand. Demand was really the primary driver then. We were also in a global financial crisis back then, which had an impact. And there were some supply disruptions, but it was really driven by demand. that demand dropped off quickly as crop prices dropped off back then. And that was one of the reasons why you saw that rapid decline in fertilizer prices. Again, I don't know when or how soon or how long fertilizer prices are going to stay this high, but I can tell you, as Dan mentioned this time, we've got sort of a new commodity cycle. And again, it looks like crop prices may stay up, as Dan mentioned, for about 2 to 3 years. That's going to keep a lid on where fertilizer prices fall to. So that demand will keep increasing. The supply disruptions will eventually, come off, particularly the export limits by some of these countries. But again, the demand will stay strong. So fertilizer prices are high and they will come down at some point, like prices always do, but they may not fall as quickly or as low as they did last time. So with that, I'll just turn it over to Gregg.
We're going to go to Kanlaya Barr. She is the senior economist with John Deere. She manages the global team of economists who oversee industry trends and agricultural markets globally. Kanlaya has been with John Deere for just about a decade. She has held various roles in forecast analytics and agriculture worldwide, as a Latin American economist, etc. She is very well known and respected in the industry. Kanlaya, take it away.
Thank you very much, Gregg, and good morning, everyone. It's my privilege to be here, and thank you Farm Foundation for the invitation and putting on this really interesting and timely information as we are thinking about the next year, what to expect. I appreciate Amanda for her really interesting outlook on trade and the summary that we're looking at. That's really important for us. And Dan, you, every time I heard you speak, you always have these thought-provoking information. So I appreciate that as well. So I look forward to hear more about the fertilizers. That's really important for our producers as we look into the next year and the next couple of years as we move through the cycle. So what I thought I would do today is to kind of talk a little bit more on the supply chain and how we're seeing this in the machinery space here. And to think about supply chain, I would say we have to kind of step back a little bit and look at what are we expecting to see from the economic recovery standpoint. So I'm going to talk a little bit more on what we think is going to happen next year is that the economic recovery would likely continue in 2022. But if you think of where we have been in 2021, things have been really strong. So we just think that it's going to continue, but perhaps not going to be as high pace as we saw in 2022. So that's the first thing. And the second thing is that while supply chain disruption is going to continue next year, perhaps see some relief as we move into the second half of 2022. Machinery demand continue to be strong, especially piggybacked from what Dan said about the price of commodities has been trending high. So that's going to continue to support the machineries market. And I have a slide to look at the used market as well from Tracker Zoom. And then finally, all of this remain highly uncertain. We have seen how the path of the virus and the weather event really changed the global crop balance sheet, and that would likely continue to do so. So we keep track of those, the path of the virus and the weather very, very closely. So with that, let's look at the first one, please. So this is the frequency indicator on how the economy is recovering in the US. As you can see here, the first graph on the top left here, retail foot traffic has already above and beyond where we left off before the pandemic level. Hotel occupancies is kind of almost there. We're about 10% below the pre-pandemic. The restaurants recovering well, the air traveling is recovering well. But I do want to point out, if you look at where we were in August, September timeframe there, that's when we start to see the progress stalling because of that re-emergence of the Delta variant. And therefore, as we move forward, I think this is going to continue to be a name of the game here. We'll see some slowdown or stalling in the recovery as we move forward, as we transitioning from the pandemic into the endemic side. But we do expect that to continue into next year. Next, please. And it's important that not only the US is important for the cases we look at. You look at the next slide here, that was showing number of cases we are seeing globally in the US and also in other countries as well. Maybe my deck is on my side is not showing, but thank you. But if you see here, when we see the resurgence of COVID-19 in different parts of the world, I want to point out to what happened in Vietnam during this August, September, when we had the Delta variant. Well, that when the supply chain that was slowly improving went backward again, the recovery went backward. So as we recovering, it is likely that we're going to see that disruption if we see that pockets happen. But we do expect to see progression in controlling for COVID, not only in the US, but globally as well. So then that means that the resurgence is unlikely to derail the economic recovery in 2022. And the example of the latest resurgence of the Omicron variants that perhaps lead us to think that, while we try to see the government try to protect the healthcare, avoid the stress in the health system, but generally the severe lockdown that we saw early in 2020 is unlikely. So that is reassuring, but at the same time, we want to make sure that we continue to see this progress in vaccination, not just the US, not just developed world, but also throughout the world to protect our supply chain. Next slide, please. Now, this is showing us where the economic recovery, what we expect. In 2021, which is the black bar here, you can see the US recovery at about 5.5%. Basically, this is the growth, GDP growth. That is showing us at the highest level how the recovery is in the US. And our long-term growth is usually about a little over 2%. So compared to the long-term growth, what we saw this year is really a great recovery from the low base last year. As we continue into 2022 here, the growth is going to continue, but perhaps at slower pace. And there are many reasons for that. Think about the waning effect of the fiscal and stimulus accommodation is winding down. We see the pent-up demand perhaps has been met. We're probably going to see some more demand to refill the pipeline inventory, but perhaps not the same extent that we saw in these past 18 months. We also expect to see some countries can grow much better than the other countries, depending on how effective they can control for the virus. As you look at from China perspective, we do expect to see some growth continue next year, but at a much lower level than what had happened in the last 20 years. And we have seen slowdown in Chinese demand and also in the real estate troubling that's happening right there. So all in all, we expect to see some of those growth continue, but at slower pace. Next slide, please. And as Dan talked about earlier about how what we happened this time in 2009 when we had the great financial crisis, the people are losing their jobs and lost their home. So we saw the saving rate is going up during that time, but nobody's buying anything. But if you fast forward to what happened this time around, we injected $4 trillion into stimulus of all the three packages that we're putting in there, so that we see the saving rate has really skyrocketed. And that's why we see consumers' confidence had been high until recently. It has been coming down. We see the saving rate is coming back down to a more historical level. And that's one of the reasons we think that the consumer spending that we saw last year is unlikely going to continue in 2022. But don't get me wrong, we are probably not going to be spending as much money as we did in 2021. But the wage growth is still pretty high. We still continue to see some elevated purchasing, but perhaps not at the same high peak level. We might perhaps coming off from the peak level. Next slide, please. On the labor side, this is also very interesting because when you think about supply chain, labor is a big part of it. We still have about 10 million jobs opening, and we have about 2.5 people coming out of labor force that hasn't come back into the labor force since the onset of the pandemic yet. So what happened there? There are many reasons economists think about this. Maybe there are some folks that still stay on the sideline because they have some time to stay at home. Maybe they're rethinking about their career. Maybe they don't have a dependent childcare right now. Maybe they think about early retirement or living with a family with high health risk. So all of those just kept folks away from the labor force. But keep in mind though, that right now the wage growth is about over 5% year over year. So we believe that we're going to start to see some of these high wage growth going to start to bring in some labor into the labor force. And that's going to help relax some of the supply constraint there going forward into 2022. But again, it hasn't done that in the past few quarters here, but we do hope that we would start to see some of those relaxation in the labor supply as we move into 2022. Next slide, please. Now, if you look at in terms of input cost here, I know this is not showing every sector, because I know we already talked about we will talk about the input side and also on the crop side. But for the overall, the other sector in the economy, input costs will likely still remain elevated in 2022, and perhaps we're going to start to see some easement coming out in 2023. Looking at home improvement, maybe with the consumer spending is projected to come off peak in 2022. People getting out, they diverting money from home improvement to service and hotel and hospitality. So we're going to see that coming down a little bit. But for other sectors on the construction side, things are still remain to be elevated there. Next slide, please. And Amanda talked about this on the inflation side, and this is the data from October, but November we're already reaching 40-year high. And as of the Fed coming up yesterday, we're probably going to see a few times interest rate increase in 2023. So I think that would be interesting to keeping an eye on how that would affect the housing market and also the farmland value. But with the high crop prices that I mentioned, that might help still stabilize the farmland value there. In terms of the next slide, then we can see the used equipment with the consumer demands remain to be strong with the crop price forecast. Right now, crop price this year, USDA forecast is a much higher level than what it was last year. So all of these lead to a very, and we have supply constraint, every part, we have chip shortage, we have hydraulic, pump, wireless harness, everything is just in short supply. So therefore we see a very strong demand in our product, both new products and also for the used equipment as well. This is from Tractor Zoom there that you can see the light chart on the left, that the change of price of equipment depending on different kind of products here, but everything is between 5 and upward of 10% increase. Look at row crop tractor especially, we're looking at between 7% increase or almost 30% increase for the large row crop tractors. Now, and the volume is also not only the price increase, it's really hard to find our equipment as well. And look at our order bank from John Deere perspective, you also see very strong order bank as well. And that is also true for the used equipment. We see the volume, the availability of the used equipment in the market is also coming back down. So all of this will lead us to think that, next slide please, 2022 would continue to be a good year for agriculture and also the equipment demand as well. In the next slide, you can see that right now in our forecast for John Deere, we expect the industry to be up about 15% for the large ag side, and perhaps on small ag with the continuing improvement in dairy prices that Dan mentioned, and also with the herd liquidation help support beef price, likely to see some of those supporting factor for the small ag producers as well. So now the next slide, just a key summary here, economic growth continue, but perhaps at a slower pace. And we're likely to see supply chain disruption easing up maybe the second half of this year, and machinery demand continue to be strong. So I look forward to this discussion. Thanks a lot, Greg. I'll turn this back to you.
I'm going to take the opportunity to begin the Q&A conversation here and see where we're at here, because we want to fill this time as best we can. My first question, Kanlaya, is to you, and it's about labor. And you're a great person to speak to this from your vantage point. We know labor is tight in the United States. We know, Dan talked about it's a huge problem on the meat processing side of the equation. But can you give us some perspective on the differences between what it is here in the United States and perhaps what it is in Europe or in Asia? Mm-hmm. What is the labor situation here compared to the rest of the world?
I think it's actually more acute here in the US and in the UK. The UK probably has to do with when the UK split up from the EU. Then that leads to some of those shortage. But European labor, we didn't see this much increase in wage. So that means their labor is not as tight. So looking back into the US, so I definitely think that situation is more acute here. And if we think about what might have caused that, even before the pandemic, we have a hard time finding folks when we just have a job opening in our factories, especially people, quite frankly, when you're competing with Amazon, working in the warehouse, you're starting at $15, $20. It's just harder for folks. And we just have a lot of difficulties even before pandemic, and this just making the situation worse. Greg, you might be on mute.
Thank you. I'm going to appreciate those comments. I'm going to ask one more question to Dan here, and then I'm going to go to some of the questions in the Q&A. Dan, excellent presentation. One of the topics, though, you really didn't cover that we need to talk about for 2022 is, given the situation with fertilizer, what's going to happen between corn and soybean acres and the battle for acres in this limited number of acres. That's one of the huge topics. And throw in a little conversation about cotton and wheat in there while you're at it.
That's a good question, Greg, and there's only so much time to do a 15-minute presentation. But that being said, our surveys of our producer clients would indicate that farmers will plant less corn and more soybeans. We have our corn acreage falling to 90.5 million acres. It's down about 2.7. And we have soybean acres rising to 89.5 million acres, right under the record. So today, as things sit, we think farmers will plant more beans, but I've never seen, at least in my recent career here, where farmers are so reluctant to buy seed. As you talk to the seed industry, they'll tell you that farmers are just waiting to decide what fertilizer and chemical costs and glyphosate availability will be before they're making their planting decisions. So this is a moving target, if you will, that's going to happen all the way into the month of March.
Yeah, there's no question about it. Harry, are you with us? Let's start with a couple fertilizer questions. The first one is please address fertilizer import possibilities between now and spring, considering the politics and the tariffs. So yeah, I know you can't talk about prices, Harry, but what is the prospect to quickly fill any gap here with some additional imports?
Sure. Well, again, imports are coming in. There's really has not been a big drop in imports. Like, as I said, phosphate fertilizer imports have recovered, and nitrogen imports are, through June, we're not down very much. The issue is more the price. Imports are still available, but the issue is obviously you have to compete or pull that product away from other countries which are trying to import materials. That's really there's still, material out there, but, the issue is, are you willing to pay that price to pull it away from Brazil, to pull it away from other, just like in the case of crops, when supplies get tight, you have to outbid other countries. There's nothing different now, as always is the case. It's just that the prices are higher.
Well, and I think that's right. And I think it's important. You raised a very important point, and you mentioned India, but doesn't China and Russia also subsidize its fertilizer prices to its farmers?
But to some extent, yeah, but not like, yeah, and they do it a little more indirectly, like they're doing now. Yeah, China does, Russia does, but what they're doing now to keep prices down is limiting exports. That's right. How they're trying to keep the supply within the country, which obviously limits the supply available to the rest of the world. So,
very good. One quick question too on fertilizer: what percent of what we use in this country, in the United States, goes to agricultural production as opposed to industrial or residential use, like golf courses, home use, residential, etc.?
Sure. So the nitrogen market, for example, is about 20 million tons approximately. About 12.5 million tons of that is sort of agricultural use. Then there's again, about 2 million tons, 2.5 million tons exported, depending on the year. And, close to about 5 million tons as well is industrial use. So, a big chunk of industrial use that, people often forget about. The nitrogen materials produced by the fertilizer industry are, used in many different uses, not just in fertilizer. And that's a big share that we often forget about.
I think that's a really important point. Exactly right in this conversation. Well, Harry, thank you. We're going to switch over and talk about trade policy here just a second with Dr. Countryman. The question is, what would you see as the most important priority or bilateral relationship for the U.S. to target in the coming year in terms of trade agreement? Amanda?
Thanks, Greg. I think I think continuing to focus on China should be the #1 priority in the coming year, especially because we're reaching the end of the phase 1 trade deal. There are a lot of question marks about what's going to happen in the coming year and the years beyond that. So I think there are still a lot of really important policy aspects that were not addressed in phase 1 that need to be continually discussed. I think they're incredibly challenging. Again, these are domestic policy issues and challenges related to the Chinese economy and the way it functions that are going to be very difficult to tackle. So I don't want to underscore the difficulty of trying to move forward with a phase 2 deal. But beyond the additional things that need to be addressed, we're coming to the end of the phase 1 trade deal. So what's going to happen next in terms of, will we have continued purchase commitments? Will there be an advancement of some of the policies that are still left undone, is the big question. So in reality, I think the most important #1 priority in the coming year from trade policy perspective should be China. And along with that, I think there's this underlying, perhaps underlying may minimize the importance of the influence that the European Union has globally in terms of the constraints that they put on production practices that are allowable for trade. And they're imposing those restrictions on countries they have trade deals with. So this ties back to China because the US is one of the top 3 suppliers of agricultural products to China. We're second to Brazil and barely ahead of the European Union. So given the tensions between US-China trade relations over the past number of years, I think it's important to continue to move forward, but also to really keep an eye on the influence of the European Union in China as well, and with other trade partners. So again, I think China is #1, but there's some underlying factors there that matter too.
I think that's a very good answer. One of the key points I would make for everybody to understand in terms of bilaterally negotiating a trade agreement with another country is you have to have trade promotion authority, which has expired. And so the first step here is to get Congress to reapprove that. I think that's something everybody in agriculture ought to be emphasizing, because without it, you're dead in the water. You're just not going to move. And I'm going to take a minute. I did spend a little time on China while I was in my previous job in negotiating the phase 1 agreement for agriculture. And the question that I get sometimes is, did it really matter? Did what we do in the phase 1 matter? And my answer is, yeah, it did. And in 33 negotiating sessions that the Vice Minister of Agriculture and I spent hundreds of hours together talking about all of these issues. Here are the 2 metrics. In the agreement, we fixed some 57 structural things in our trading relationship between the US and China and agriculture. Of those 57 things, 54 or 5 or 6 of them are fixed, done. As a result of that, here's the key statistic. Before we started those negotiations, we had some 1,500 facilities in the US eligible to export products to China. Today, as a result of all of the effort we did with new facilities being approved, new products being approved, and I'm talking about pet food facilities and meat processing facilities, infant formula facilities. We've taken that 1,500 facilities to well over 4,000 facilities in the US that are eligible to export agricultural products to China. And that has made a huge difference in our access into the Chinese market. So I think that's something that I'm very proud of is that process. And I know you talk about phase 2, and to do that, you've got to talk about state trading with China, and that is a really tall order. But I agree with your sentiment and comments. One last question I've got on the board here, and then we can see if we have any more, some things we open it up to talk about, because Dr. Countryman, you mentioned the EU and the EU farm to fork situation, and then we talked about fertilizer in the EU. I want to get to that, but first I want to get to a question for Dan on the interplay between biofuels and soybeans. Would you anticipate that we might flip to importing soybeans, God forbid of all things, as the biofuel processing capacity increases like what you described in your presentation?
Gregg, we sure could. And this is where the bedfellows get a little strange, in that we could import beans. But we could also export beans to our friends in Europe. One of my dilemmas today is I don't have enough crush capacity in the United States. And so maybe I have to utilize that excess crush capacity in Europe, export the beans to Europe, they use the meal, and then we import the oil from Europe, and it still is going to be US soybean oil, which would be, of course, getting the subsidies from California, Oregon, and Washington under renewable diesel.
All right, the next question I'm gonna ask you here, you and I spoke at a conference, your conference that you helped put on in Geneva, Switzerland this fall. Fascinating discussion with regard to if the Europeans actually do implement this insane notion of farm to fork and cut acres and fertilizer use and pesticide use like what they're talking about. Dan, what did we learn over there in those conversations? Can you help walk through with people what that means? And then the second step of that is they actually already have cut a chunk of their fertilizer production. When you add all of that up, and I'm going to have you react to that, and then I'm going to have Kanlaya kick in with her opinion on this. This is a big deal.
Oh, it's a huge deal. We had a paper presented by CoSerial that showed that the EU, which is the second largest grain exporter, I'm not including oilseeds now, just grains, is going to be at about 38 million metric tons, is going to import as much as 60 or 70 million metric tons by 2030. The world just does not have that much agricultural production for that major food producer to now become an importer should they adopt farm to fork. And their political mindset is that they need to save the planet for generations to come. Sustainability is where they're looking at. I think this gets done, but it's a tremendously important and sizable seismic shift in world agriculture.
Kanlaya, chime in here, please.
Yes, to add to the farm to fork, now we start seeing this notion of proposal to restrict import from countries that is linked to deforestation. So I think all of it is just, I can see 5 years from now how the trade flow could potentially change. I don't know, Dan, you say we need, if we to fulfill that 5 billion gallons of renewable diesel, that's 40 million acres of soybeans. Where is this going to come from? If we're going to put those in the CRP, and Brazil can't expand because European Union won't take it. Then we could be talking about, is that going to lead to high food prices? So I think these are just the greenflation. In my mind, it's becoming more and more real that we have to figure out how we're going to solve all of this and still have affordable food for the rest of the world.
Yeah,
Greg,
go ahead.
To tag along with Kanlaya's comment, I would also like to remind everybody, not only are we going to have this big oil demand, but what are we going to do with all the soybean meal? I haven't been able to figure that out either, because we would supplant Argentina as an exporter, and the world just doesn't have that much demand. You can only run rations so hot for a single stomached animal like a chicken or a hog. Maybe ruminants can do a little more, but that's another aspect of this biodiesel that I just can't figure out.
Well, it certainly has implications too for where you're going to grow livestock in the United States in the future. If you have a really good source of lower price, lower basis levels for soybean meal, you talk about the dairy industry, Dan. You could see that thing move a little bit further to the west, out to where you have that better source of feedstock.
Very well could be, Greg, and I'm going to need that dairy industry to produce a lot of beef, black calves, if you will, because for the cattle industry, I really need to bump up the feeder cattle supply to prevent the price of beef going even higher.
No, I want to chime in here just a second on this, and let Harry give us a little further distant outlook in fertilizer, because he is a driving force here when I say and Dan, you talked about it. So folks, over the next few years, there is really nothing on the horizon that tamps down food inflation. There just isn't. With the potential down the road here a little bit of getting a little help on the price of fertilizer. So Harry, what do you got for us here on down the road? What do you see?
Depends on how far down the road you're talking. And what I'm trying to say is, again, as I mentioned, it takes years to build even a new nitrogen plant. And, those are the quickest ones to build, and that's kind of 3 to 5 years. It takes even longer, for a phosphate mine and phosphate plant and, a potash mine. And again, you have to have the resources available. You can't just build a phosphate rock mine or a potash mine in your backyard if there's no phosphate or potash ore, So, these things take a long time. It's a little bit like if corn is short, well, you got to wait till, another crop comes, right? And it's similar with fertilizer, but it takes much longer for these plants to be built. And again, another thing, even ramping up production takes time. These nitrogen plants are run at high operating rates. So, you can ramp up production to some extent, but, only to a certain extent. And similarly with these mines, it takes quite a bit of time to ramp up production. It's not like a Subway sandwich where you can, make more sandwiches or open up more shops real quickly. These things take time, but as it did last time, production will increase over time in response to the higher prices, but there'll be, quite a lag involved. And that's these, supply disruptions we're looking at now, COVID related, another aside.
All right, we have about 5 minutes left. I'm going to ask one general question for everybody to offer some final comments, is the fact that given everything you've heard here this morning, on the other side of this, we have an administration that wants to talk about ESG. They want to talk about declining fossil fuels, increasing more in terms of renewable energy. And we have a big change in discussion there. Quickly, a minute each, how does this discussion of renewable energy and reduction in carbon footprints affect agriculture? Harry, I'll start with you and we'll go to Amanda next.
Sure. I think probably the biggest impact on the fertilizer industry will, be two. One, obviously, ethanol demand, things like that, help corn demand, and that helps fertilizer, right? That's number one on a positive side. On a negative side, though, all these efforts could have an impact on, energy prices. So that obviously could increase cost. An additional thing is green ammonia. As that's going to take some time, but that could pull production, away from, agricultural uses and increase the price of, agricultural fertilizer in the future.
Amanda.
So I think, Dan mentioned that this topic in particular can be a major disruption in the very near future. And from my perspective, I think even though it is anticipated, the importance of having a reasonable transition towards these new standards and expectations, I think, is going to be the most important thing. Without a realistic, reasonable transition expectation, especially from the US, I think having too short of timelines for change is going to be too challenging, personally. So I think the biggest thing from my perspective is to have a reasonable timeline and expectation.
A really good point. Galia.
Yeah, I think there could be both risks and opportunities for the ag sectors. On the risk side, as mentioned by the panels here, that all the inflation could happen, and on all the other side. But on opportunities, there could be money that can be made from ESG that producers can actually can be working on, and the renewed interest in biofuel. Those could be a positive side as well. So I think back to Amanda's point, just that. What kind of timeline are we looking at, and how can we help producers and take advantage of that in the short term here? So I think these decades will be a big transition in technology. So I want to make sure that we're getting ahead of it.
There is an unbelievable amount of money being spent in new technology in agriculture. It's just spellbinding. Dan, bring us home here. You've got 1 minute.
Well, the profile of American farmers and all of us around the food table is going to be raised over the next 3 to 5 years. Our place gains in prominence. And in saying that, I believe farm profitabilities will stay high, but market volatility is going to be acute. So it's what you do with the markets and how you treat the opportunities, which will be key, Gregg. Thank you for your great moderation.
Sherry, I'm going to turn it over to you.
Great. Well, first, thank you everyone for your extra resilience today with the unusual technical difficulties. And thank you, Ambassador Doud. And thanks to all of our speakers for the wonderful discussion today. I'd also like to thank all of you in the audience. for joining us and submitting your questions. We'd appreciate your engagement with us and would love to hear your feedback. So please take a moment to share your comments about today's session in the brief survey you will see at the conclusion of the forum. If you'd like to help us continue providing valuable programming such as today's forum, I'll quickly remind you about becoming a friend of Farm Foundation. Check the link provided in the chat to learn more. Each and every gift to Farm Foundation strengthens our ability to address rapidly evolving issues impacting agriculture, the food system, and rural communities. And we are so appreciative of your support. So thank you once again for your participation today, and we look forward to seeing you in future events. Thank you.